In the shadowy world of high finance, one man stands out not for his bravado, but for his silence. He's a ghost, a legend, a code breaker who turned the chaotic noise of the market into a predictable, profitable symphony. This is a story of Jim Simons, the mathematician who built a money-making machine unlike any other. Before Wall Street, there was Jim Simons, the prodigy, a brilliant mind obsessed with patterns and shapes. He earned his PhD in mathematics at just 23, worked as a code breaker for the NSA during the Cold War, and later chaired the math department at Stony Brook University. He was a pure academic, driven by curiosity, not cash. But a question lingered in his mind. Could the elegant logic of mathematics be applied to the seemingly random world of financial markets? In 1978, Simons took a leap of faith. He left the ivory tower of academia and founded a hedge fund called Money. His initial attempts were, to put it mildly, not great. He tried trading currencies based on fundamental analysis, predicting market moves based on economic news and political events. It was a gut-driven, human approach, and it was failing. Simons realized his own intuition, his own human biases, were his biggest enemies. He needed a new system, one built not on feeling, but on pure, cold, hard data. This pivotal realization led to the birth of Renaissance technologies in 1982. Simons decided to stop trying to predict why the market moved. Instead, he would focus entirely on how it moved. He assembled a team not of Wall Street traders, but of brilliant misfits, mathematicians, physicists, statisticians, and computer scientists. These were people who saw the world in algorithms and data points, not in profit and loss statements. They were tasked with a single monumental goal: find statistically significant, non-random patterns hidden within mountains of historical market data. They began collecting everything. Decades of stock prices, bond yields, currency fluctuations, commodity trades data stretching back to the 1700s. They cleaned it, organized it, and fed it into powerful computers. Their approach was radical. They weren't looking for a single grand theory of the market. They were hunting for tiny, fleeting, almost invisible correlations, what they called signals. A faint whisper of a pattern that might predict a price move a few seconds, minutes, or days into the future. Imagine listening to 1 million radio stations at once, all broadcasting static. Their job was to find the one station playing a faint, repeating melody. They developed complex algorithms to identify these signals. For example, did a certain stock tend to dip slightly on sunny Tuesday mornings before rising in the afternoon? Did a basket of currencies behave in a specific way after a particular economic announcement? Individually, these signals were weak, almost useless. But by combining thousands of them, they could build a powerful predictive model. This system was the engine behind their legendary Medallion Fund, launched in 1988, exclusively for employees of the firm. The fund strategy was a black box. It executed millions of trades a day, buying and selling with lightning speed, capitalizing on tiny inefficiencies that were invisible to human traders. While other investors were reading headlines, the Medallion Fund was listening to the secret hum of the market's data stream. The results were simply staggering. From 1988 to 2018, the Medallion Fund generated an average annual return of 66% before fees. After its hefty fees, it still returned nearly 40% annually. To put that in perspective, Warren Buffett, perhaps the greatest investor of all time, averaged around 20%. Simons' system didn't just beat the market, it broke it. It was a paradigm shift, proving that a purely quantitative, data-driven approach could vastly outperform human intuition and traditional analysis. But this success didn't come easy. The early days were fraught with challenges. The models would often decay as the market patterns they were built on would disappear. The team was in a constant arms race against the market itself, endlessly searching for new data, new signals, and better algorithms. There were moments of doubt, times when massive losses tested their faith in the system. They faced technological hurdles, building computing infrastructure that was years ahead of its time. One of the key figures alongside Simons was Robert Mercer, a brilliant computer scientist who specialized in language processing. Mercer helped refine the models, making them more sophisticated and adaptable. Together, this team of academics, once outsiders on Wall Street, had built a fortress of secrecy and unparalleled success. They didn't give interviews. They didn't share their methods. The inner workings of the Medallion Fund remain one of the most closely guarded secrets in the financial world. Jim Simons proved that the market wasn't just a casino of random chance. It was a complex system with its own hidden language, and for those with the intellect and the tools to decipher it, the rewards were beyond imagination. He didn't just solve the market, he rewrote the rules of the game entirely, ushering in the age of quantitative trading and forever changing the face of modern finance. Inside Renaissance. It wasn't a Wall Street trading floor. It was a geek paradise. Simons fostered a culture straight out of a top university research lab. No one cared about your background in finance. In fact, it was a disadvantage. He wanted astronomers, code breakers, and physicist people who saw patterns where others saw chaos. The mantra was collaboration. Ideas were shared openly in daily meetings and weekly research presentations. Everyone, from the top scientists to the newest hires, was encouraged to challenge assumptions. There were no private offices, just shared spaces filled with whiteboards covered in complex equations. This wasn't about ego. It was about one thing: finding the truth hidden in the data. And the system they built, Medallion, was the ultimate truths. Medallion was more than just a collection of algorithms. It was a single, monstrous, self-learning brain. Every trade, every piece of data, every success, and every failure was fed back into the system. It evolved. It adapted. The code grew so complex that no single person understood all of it. It was a living entity, constantly hunting for tiny, fleeting, and predictable patterns in the market's noise. It traded everything from hog futures to German bonds, often holding positions for just minutes. This wasn't investing. It was a high-frequency statistical arbitrage on a planetary scale. While Wall Street chased gut feelings and quarterly reports, Renaissance chased statistical certainty. And the results, they were simply unreal. Year after year, Medallion churned out returns that defied belief, averaging an astonishing 70% before fees. But no system is invincible. The first major test came with the Asian financial crisis in 1997, as markets in Thailand, Indonesia, and South Korea collapsed. Volatility went through the roof. Medallion's models, built on historical data, started to flicker. The predictable patterns it relied on were drowned out by pure, unadulterated panic. For the first time, the fund faced serious losses. Inside Renaissance, the atmosphere was tense. Was this it? Was the model broken? But Simons held his nerve. He trusted the math. The team didn't panic. They dug deeper into the data, tweaking the models to account for the new, chaotic regime. Slowly, as the storm passed, Medallion found its footing again, proving its resilience. It was a brutal lesson. Even the best models can be rocked by human fear. Then came the dot-com bubble. As tech stocks like Yahoo and Amazon soared to insane valuations, Medallion was perplexed. The system saw no logic, no historical precedent for this mania. So it largely sat on the sidelines, even shorting some of the high-flying tech darlings. For a moment, it looked like Renaissance was missing out on the party of a lifetime. Outsiders scoffed, but Simons and his team trusted their system. Their rule was simple. If the model doesn't see a signal, you don't trade. Emotions kill profits. And when the bubble spectacularly burst in 2000 and trillions of dollars in paper wealth evaporated, Medallion was not only safe, it profited handsomely from the collapse. It was the ultimate vindication of their data-driven, emotion-free philosophy. But the greatest test, the near-death experience, was the quant quake of August 2007. It started suddenly, without warning. Across the board, quantitative funds just like Renaissance started losing money at the same time, in the same way. It was as if the secret strategies had all been exposed and were being traded against. The losses were catastrophic. Renaissance was bleeding hundreds of millions of dollars a day. The models were failing. Total meltdown seemed imminent. Inside the firm, it was red alert. The team worked around the clock, trying to understand what was happening. They discovered a larger prime brokerage firm was liquidating a massive quant portfolio, forcing prices to move in bizarre, correlated ways that blew up everyone's models. Faced with potential ruin, Simons made a gut decision, something he almost never did. He began to manually override the system, reducing risk and delevering to stop the bleeding. It was a terrifying moment, a clash between man and machine. For a few days, the machine lost, but as the forced liquidation ended, the market snapped back. Simons quickly turned the models back on, and the system roared back to life, recouping all the losses and then some in a matter of months. They had stared into the abyss and survived. As the money piled up, so did the political scrutiny. Renaissance became a powerhouse, not just in finance, but in politics. Robert Mercer, who became co-CEO after Simon stepped back, emerged as a major political donor, funding a wide range of conservative and right-wing causes. This brought a new, unwanted kind of attention to the secretive firm. The company that ran on pure logic and data found itself in the messy, emotional world of political headlines and controversy. It created deep divisions within the company, a clash of ideologies that the founders had worked so hard to keep outside their walls. The quiet paradise of geeks was now in the public spotlight, a symbol of the immense power that concentrated wealth and data could wield. For Jim Simons, the final chapter wasn't about accumulating more wealth. It was about giving it away. Having solved the market, he turned his brilliant mind to philanthropy. He and his wife, Marilyn, poured billions into scientific research, education, and health through the Simons Foundation. He funded research into the origins of the universe and the mysteries of autism, a cause deeply personal to his family. He launched Math for America, a program dedicated to improving math and science teaching in public schools. The same drive that pushed him to find signals in market noise was now being used to tackle some of humanity's biggest challenges. He had cracked one code, finance, and now he was trying to crack others for the benefit of all. So, what are the ultimate lessons from the man who solved the market? First, trust the data. Opinions, gut feelings, and narratives are seductive, but the numbers don't lie. Second, build a culture of radical open-mindedness. The best ideas win, no matter who they come from. Third, be prepared for the storm. No model is perfect, and reality will always find a way to surprise you. Resilience is as important as brilliance. And finally, success isn't just about what you gain. It's about what you give back. Jim Simons' story is a testament to the power of a different way of thinking, proving that sometimes the quietest person in the room, the one just looking at the numbers, is the one who will change the world. Thanks for watching. If you want to see how this incredible journey began, check out the full playlist and don't forget to subscribe for more stories like this.